You have traveled to China on behalf of the Trump administration. Obviously, trade is the agenda. I know you've said that this president doesn't want a trade war, but what will it take to have trade peace?
Well, I think what it takes is the gradual opening of China, if we're just talking about China, and their adoption of more traditional types of practices that would be in the developed world. And I think they recognize that over time that needs to happen, and it'll be good for them. But it represents a major change from the way China has been managed. So these negotiations have not been the easiest, because you're asking someone to adopt different types of approaches that are more common in the developed world. I don't think China will ever abandon a lot of the fundamental tenets of its system, but the game is to rebalance in a way that makes a lot more sense as China becomes wealthier.
I know that you've said you're not afraid of an imminent recession, but there are shocks that could happen. Is trade the one you watch, or is there something else you're keeping your eye on?
Well, there are all kinds of unusual things that happen in the world. My own sixth sense is that geopolitical issues are the great unknown, which could have very, very substantial consequences, and are really a lot out of the box. So, what happens with Iran, and do they become militarily aggressive, interfere with the supply of oil to the rest of the world from the Middle East? You've got issues like North Korea, what happens there. You've got issues with China on numerous kinds of levels. And you never know which one of these things, let alone other things, are going to happen. The world's become much more integrated for a lot of different reasons, including the internet, where people's behavior, which used to be not correlated, all of a sudden people around the world start acting in the same way. So the conventional economic cycle with overproduction of certain types of goods that lead to, sort of economic slowdowns and so forth, doesn't appear to be what's really the risk to me at the normal moment. What happens with interest rates, which are now so low that it's almost unnatural, and what happens if they reverse, if we get some inflation, that a little inflation would be fine for most of the world, but if that goes up a lot, there are always risks to economies, but at the moment, the low interest rates have stimulated the world enough that it just seems to be rolling along. And in the United States, for example, lower income workers for the first time are getting much bigger increases, somewhere around 3.5%, 4%. Well, as they get more money, it is 70% of the spending of America, consumer, they spend more. And the more they spend, the more the economy keeps growing. So it's not a conventional cycle, but I don't see it falling off a cliff.
You quite famously called the top of a real estate cycle with the equity office property deal and sale of the assets. As you look at real estate now, having built another big fund, where do you think we are in this cycle for real estate? Well,
real estate's interesting because the way real estate cycles die is with new supply. And if you build too many things, then the value of the other stuff ends up going down because you can't fill all the buildings and the rent goes, the buildings start becoming partially empty and the rents go down, and all of a sudden people have problems in the real estate business. That, in the developed world, does not seem to be happening. Supply is quite low. by historic standards. And so it looks like we'll have a much longer real estate cycle, particularly because interest rates will probably stay low for a while. But that overbuilding, which always kills it, isn't apparent.
Your firm played a role post-mortgage crisis in buying up real estate, one of the single biggest owners of properties, residential properties, and some criticism came your way, including from the United Nations. Can you just reflect on what you think about the role you did play and are playing in that part of the market?
Yeah, sure. Actually, it wasn't the United Nations. It was somebody who worked part-time and wrote something, which we don't think was right. But basically, what we did after the crisis with residential housing is the regulators dramatically increased the down payments needed to buy a house. And so before the crisis, it was like 5 or 10%, and that encouraged an enormous number of people to buy houses. And when things collapsed economically, prices of houses went down 30, 40%. What the government did was increase the down payments up to 20, sometimes 25%. So what happened? Nobody could afford to buy a house, even though houses were down in price. The money you had to write a check to buy a house was so big, the market just like couldn't recover. So what we did is we bought, about 50,000 houses. It was pretty small in the context of the United States. It was like 0.5% of the homes that are rented, but close to 1/10 of 1% or less of total homes. It was almost nothing in the scale of the whole thing. But what we did is we spent about $25,000 a house to fix them up. And then we rented them to people who didn't have the money, which was almost everyone didn't have the money to be able to buy a house. And we bought in places that typically would have very good school districts. So people would be able to move into those houses and send their children to good schools. And we hired all these workers to fix the houses. So we think we did like a very good thing. And we've actually sold all of our stock, with that program. We doubled our money for our investors who are pension funds, police, fire, teachers, government officials. So that's where the profits basically went. But in terms of a force for good, I think we did a really good thing for society.
You mentioned the effect of monetary policy and the odd situation that we're in, including negative yielding rates globally. How does that change what you're thinking about returns you can expect, how you capitalize, how you finance? Are you having to rethink some old rules here?
Well, some of that doesn't affect things too much. It makes money cheaper. So people tend to have higher values they pay when it costs less to finance it. The amount of financing isn't that much higher. In fact, it's lower on the things we buy, because if the prices are higher, the banks and everybody else doesn't want to give us more money, and take more risk. What happens is you put up more equity. Mm-hmm. So the leverage in structures has gone down materially. So from the perspective of the banks and the system, things are quite safe. The risk is actually what the return will be on the
asset
equity.
Valuations.
And on as a result of putting more money in to buy something. So what it does is it makes us much more cautious. And it's a little like playing hockey. What is a normal game? You get 30, 35 shots on goal. That's a normal environment. That's when interest rates are a little different. Now we have a different environment. We only get like 5 shots on goal. Now, if we pick those shots right and we're open, we can still score 3 goals a game, and we have a really good shot of winning the game. But we have to recognize We don't get those extra 25 shots, most of which aren't well conceived in the first place, which is why you don't have high-scoring hockey games. But we can still put money out, but we have to be much more cautious.
So where are you looking? Because not only are you cautious for those reasons, but you're also, there are some other very large players. You yourself are now large enough that the deal flow will change just by definition.
Yeah.
What's interesting?
The way we do things, almost every one of our business lines, whether it's private equity or real estate or credit business, and we do a variety of other types of things, we're typically try and be in pretty much accomplished it, being the largest in the world. Now, why do we do that? We do it, among other reasons, because there's less competition. With financial assets, there are always bigger and bigger companies you can buy. And if there are very few people competing for those, just because of the scale, that in effect gives you an advantage. You're not in the crowd. We always have some competitors, but ironically, we've always had, somewhere around 7 competitors. Now it's less, and that's been for 30 years. The names of those companies tend to change, but the number of them is about the same, and we've been fine during that whole period.
Is there a place in the world you're avoiding right now? Is there a geography that you find particularly difficult?
The answer is there are lots of places, that you avoid. So some are characterized by, bad governments, inhospitable governments, and the easy thing would be something like a Venezuela, and there are a variety of countries that basically don't have a rule of law. If you live in Canada, you assume, if you don't travel much, that everybody's more or less like you, except they may look different, but they got to have something that's a similar system. That's not true. There are a lot of places in the world where there either is no actual rule of law, or where laws just don't get enforced, or they get enforced selectively, so you can't rely on them. So there are large parts of the world, some in Asia, some in Africa, where some in Southeast Asia. There are many countries where it's quite difficult. I have a simple rule that I only like to invest in countries that I'd like to visit twice.
That you go back to?
Yes, that I'd like to go back to twice. Anybody likes a place once, but would you really like to go there on a repeat basis? Usually, if you don't want to do that, that's a place to stay away from.